Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Now let's get started. This week, we're trying to cut through some seemingly contradictory signals in the financial markets. On one hand, the U.S. economy looks fantastic on paper based on recent data, but then the Federal Reserve just eased policy. So we're diving into a stack of sources today. Strong Q2 GDP, inflation that's still kind of high, and this massive inventory buildup that maybe suggests things are cooling off.
Yeah, that's exactly the mission today. Trying to understand that tension. We've got the hard data that revised GDP, jobs claims, but it seems to be clashing with forward-looking sentiment and what central banks are actually saying and doing. The real focus is, can U.S. consumer resilience hold up? Can it withstand rising costs internally, like inflation and this sort of structural drag globally from new trade tariffs?
That structural tension really feels like the key thing right now. And speaking of tension, we saw the Fed lower the federal funds rate 25 basis points just recently. They're moving toward what they call a modestly restrictive stance, and they pointed to increased downside risks to employment as the reason. It just feels, highly unusual to ease policy when inflation still looks pretty sticky. Okay, let's unpack this. Maybe start with the source of that recent confidence boost, the revised Q2 2025 GDP numbers.
Right, the GDP. That revised data, released September 25th, showed some really impressive strength. Real GDP increased at a strong annual rate of 3.8%. And that was an upward revision of 0.5 percentage point from what they'd previously estimated. Definitely surprised quite a few people.
Okay, 3.8%. What was really driving that powerful revision? Was it all just consumers feeling good and spending?
It was, overwhelmingly consumer-driven, yes. A really significant upward revision to consumer spending. We saw particularly strong growth in services, things like transportation, financial services, insurance. Those were big contributors. And, crucially, the headline number also got a bit of a mechanical boost because imports decreased. That's always a subtraction in the GDP formula, so lower imports mean higher GDP, technically. It's also kind of confirming, I think, that real gross domestic income, the GDI, matched that GDP growth exactly, 3.8% for both. That suggests the underlying economic activity is genuinely pretty robust.
Okay, so if the economy is growing that strongly, why is the Fed pivoting to easing? I guess that takes us straight to inflation. And the gauge the Fed watches most closely, the Core PCE price index for August.
Exactly. Core PCE, that's the one stripping out volatile food and energy. It came in at 2.9% year over year. This was released September 26th. It hit expectations. It wasn't a surprise, but the point is it's still stubbornly elevated, still well above that 2% target the Fed aims for. And if we look at the monthly details, personal spending actually rose 0.6% in August. That was faster than personal income, which only rose 0.4%. So that accelerated spending, it keeps the pressure on inflation.
And Powell seems to be betting that the rising tariffs are just a one-time cost shock, not some kind of structural inflation problem, right? But is the Fed making maybe a dangerous gamble here, dismissing the potential for these protectionist policies to actually entrench inflation more deeply? I mean, history suggests tariffs often lead to stickier prices down the line.
It's absolutely a calculated policy gamble, no doubt about it. In his recent comments, Chair Powell did note that while inflation remains elevated, the Fed's baseline view, their main scenario, is that the pickup in goods prices is primarily down to the recent higher tariffs. He really believes this will be a one-time shift in the price level, spread out maybe over several quarters, but not an ongoing cycle that needs aggressive rate hikes. So the decision to ease, it really leans heavily on needing to protect the employment side of their mandate. They seem to believe that faces more immediate downside risks.
Okay, let's check the real-time pulse on the labor market then. See if that downside risk is showing up clearly. We got the initial unemployment insurance claims data this week too, right? That was September 25th.
Yeah, and the employment picture, it gives us kind of mixed signals, which just adds to the confusion, frankly. Yeah, the advanced figure for seasonally adjusted initial claims for the week ending September 20th, it actually dropped by 14,000 down to 218,000. A number like that usually signals underlying stability, maybe even some tightness still in the labor market. But that directly contrasts with Powell's comments where he said job gains have slowed sharply, averaging just 29,000 per month recently. So the hard claims data looks maybe a bit better than the Fed's more gloomy assessment.
So how does that contradictory picture, tight jobs claims on one hand, but central bank fear on the other, how does that show up in business sentiment? Let's look at the September flash U.S. PMI data that came out September 23rd.
Well, the PMI results definitely confirm that momentum is fading a bit, even if growth is still happening. The U.S. Composite PMI Output Index, it dropped to 53.6. It's a 3-month low. Now, overall, the third quarter has actually been quite strong on average, the strongest since late 2024. But the key takeaway, I think, is buried deep within the manufacturing sector data.
Which I'm guessing connects right back to that downside risk the Fed seems so worried about.
Exactly. We saw that manufacturing production actually rose, but new orders were only marginal. And here's the kicker. Firms reported the largest buildup of finished goods inventories in over 18 years of survey data. Now, that kind of massive inventory buildup is a huge flashing red light. It really suggests that producers might be getting ahead of softer demand from consumers. It implies they're anticipating slowing sales, probably because of those elevated input costs driven by tariffs. That inventory pileup, that's often a leading indicator of slowing growth ahead.
So that really links the inflation story directly to the employment risk story. If consumer spending slows down, then firms stop buying inputs, and that huge inventory pileup suddenly turns into immediate cuts in future production and maybe hiring too.
That is precisely the feedback loop the Fed seems to be trying to get ahead of by signaling they're willing to ease. They're reading that manufacturing anxiety, which is heavily influenced by all this trade uncertainty, and they seem to have decided to move proactively, perhaps even before that worrying inventory data was fully digested by the wider market.
So, okay, how did the financial markets actually digest all this conflicting information? Strong past GDP, sticky inflation, a preemptive Fed cut. What did the market snapshot look like as of Friday, September 26th?
Well, the market seemed to rally on it, mostly because that core PCE number was just in line, didn't surprise to the upside. It signals that maybe investors believe the Fed's gamble, that tariffs are just a one-time price shock, might actually pay off. U.S. equity futures showed strength right across the board. The Dow was up 0.62%, the S&P 500 up 0.57%, and the Nasdaq 100 up 0.39%. That strength suggests investors are maybe pricing in continued corporate profitability and perhaps willing to look past the tariff noise for now.
Interesting. And how did that play out in the currency markets? Did the dollar react much?
We saw some minor U.S. dollar weakness, kind of reflecting that cautious optimism, I think. The USD traded higher, up at 1.1697. That's up 0.28%. Meanwhile, the USD GPY traded a little lower at 149.47. So basically, the narrative seemed to be that the U.S. isn't heading for immediate stagflation. That provided some relief, which tends to support risk-on assets like equities.
Okay, so the market seems okay for the moment, but these trade pressures, they must be hitting consumers indirectly too, right? Especially through big purchases like housing.
Right.
Let's look at the domestic housing sector. We got two quite different views this week from the August data. What about new residential sales first? That was released September 24th.
Yeah, the new homes market was, truly dynamic in August. New houses sold rose really sharply, up to an annual rate of 800,000. That's a huge 20.5% jump just month over month. And that immediately drove the supply of new houses for sale down quite a bit. It went from 9.0 months worth down to 7.4 months. The median price also held firm, around $413,500.
Wow, 20% jump, Mom. That's serious volatility. It suggests builders are maybe rapidly moving whatever inventory they have. How does that compare to the much larger existing home market, where we know inventory has been famously tight for a while now?
Right, the existing market is slower. Based on NER data, existing home sales were running at about 4.27 million on an annual rate in August. The median price there was $422,600, which reflected only pretty modest annual price appreciation, about 1.8% year over year. So yeah, the new home market, while it's smaller overall, it's significantly more reactive, more dynamic month to month. It seems like builders are maybe better able to capitalize on their inventory and construction capacity compared to the existing market, which is still kind of locked up by higher mortgage rates for many homeowners. But importantly, both sectors are showing fundamental price resilience. Prices aren't collapsing.
Okay. Now, let's pivot globally for a second, because this radiating effect of U.S. tariffs seems to be the common thread in pretty much every global source we looked at. How are other central banks bracing for this economic friction? The commentary from the Swiss National Bank, the SNB, seemed particularly revealing this week.
It really was. The SNB, on September 25th, they left their policy rate unchanged at 0%. No surprise there. But their commentary about the future was pretty stark. They explicitly stated that U.S. tariffs are expected to dampen Swiss exports and investment. And they specifically called out high-value sectors like the machinery and watchmaking industries as being particularly impacted. Their own conditional inflation forecast for 2025 is incredibly low, just 0.2%, and they're projecting Swiss GDP growth will drop to just under 1% for 2026, largely due to these trade effects.
Wow. So if that trade-related pain is radiating out to vital Swiss machinery, and we know Japanese manufacturing is feeling it too, how quickly should we expect that feedback loop to maybe hit U.S. exporters? Is it already happening?
Oh, it's definitely already happening. We can see it clearly in the Asian data. The Flash Japan Composite PMI for September, it came in at 51.1. That's the softest reading since May. And it really reveals a clear two-speed economy over there. Services are still holding up okay, around 53.0, but the manufacturing PMI is actually in contraction at 48.4. Manufacturing output saw its quickest reduction since March. And crucially, new export business declined for the 6th consecutive month. So that's confirmation, really, that the global goods trade is slowing down, and it seems aggravated by these protectionist policies coming out of the U.S.
Okay, let's try and synthesize all this. We've established U.S. GDP was strong in Q2, but core PCE inflation is still sticky, above target. The Fed is cutting rates anyway because it fears future employment risks, a fear that seems underscored by that massive inventory buildup in U.S. manufacturing, and also by the clear slowdown in global trade that we're seeing reflected from, say, Switzerland to Japan.
Exactly. So looking ahead, we really need to see if that manufacturing anxiety starts to spill over more broadly. As seen in the provided information, like on investing.com's calendar, next week brings a whole slate of crucial U.S. employment figures. We get JOLTS job openings, ADP private payrolls, the main non-farm payrolls report, and the unemployment rate. We'll also see key European inflation figures, the CPI for the Eurozone. But I think we should really pay close attention to the U.S. ISM manufacturing and non-manufacturing data. Those are scheduled for Wednesday and Friday, respectively, next week. They're kind of the gold standard for business sentiment, and they'll show us whether that worrying inventory buildup we saw in the flash PMI data is actually accelerating or maybe easing off.
Right, so the central tension is crystal clear, past strength versus future risk. We've got this strong Q2 momentum, mainly driven by U.S. consumption, but it's clashing hard with these forward-looking indicators and, frankly, central banks around the world bracing for a structural slowdown, much of it linked to protectionism. So the question for us to consider this week is this. Keep an eye on that massive inventory pileup in U.S. manufacturing. Is that the first definitive crack we're seeing in the consumer engine? Or is it just a temporary trade policy hiccup that the Fed has maybe successfully navigated around, at least for now? Something to watch closely. Thanks for watching. Don't forget to like and subscribe.